Okay, so most people are taught to think about debt in a very simple way. Credit card debt is bad, mortgage debt is good, student loans are maybe okay, car loans are kind of bad, and if you sort everything into the right buckets, you should be fine. But I do not think that is the best way to understand debt. Because a credit card and a mortgage are technically the same kind of thing. Someone gives you money now. You agree to pay it back later, and you pay a fee for using that money. That fee is the interest rate. That is true for a mortgage. It is true for a car loan. It is true for a student loan. It is true for a credit card balance. It is true when a company borrows money. It is true when the government borrows money. Different labels, same a basic machine. Money now, money back later, plus a rate. The problem is that people focus on what they bought with the debt. They ask, was it a house? Was it school? Was it a car? Was it a vacation? Was it furniture? Was it something responsible? Looking. And that is how we get the good debt, bad debt conversation. But the thing that actually determines whether a debt helps you or hurts you is usually not the label. It is the rate. And more specifically, it is the interest rate on the debt compared to what your money could earn somewhere else. That is the line. If the debt costs more than you can realistically earn with that same money, the debt is draining you. If the debt costs less than your money can earn elsewhere, then keeping the debt and investing the difference can make sense. That is the whole game. Not perfect, not always emotionally easy. But that is the number you have to understand if you want to understand debt. Think about it like this. If you have a credit card balance at 20%, that is basically a guaranteed 20% drain until the balance is gone. So the question is, could you reliably earn more than 20% somewhere else with no risk? Almost never. So that debt is not just bad because it is a credit card. It is bad because the rate is too high. Now flip it. If you have fixed debt at 3%, and your money can earn 8% or 10% over the long run, then the debt may actually help you build wealth. Not because debt is magical, but because you are borrowing cheap and earning more, samey instrument opposite outcome. The only thing that changed was the number. So let me make this real with two examples. First, meet Jake. Jake is responsible in the normal sense. He never misses payments. He keeps a budget. He pays bills when they arrive. He would probably tell you he is pretty good with money. But Jake carries about $8,000 on his credit card month to month, and that is not unusual. The source mentions that roughly half of American cardholders carry a balance. Jake does not think of it as an emergency. It is just there. A background fact, like a phone bill. He pays a couple $100s toward it every month. The balance moves down slowly, and because he is never late, it feels manageable. But here is the number Jake has never really sat with. His credit card charges 21.5%. That is around the average rate Americans actually pay on balances they carry in the original example. On an $8,000 balance, that is $1,720 a year in interest alone. Not principal, not progress, just interest. That is about $143 a month, leaving his account and doing nothing for him. And because Jake is paying around $200 a month, so much of the payment is interest that the debt takes a long time to disappear. At that pace, it takes about 71 months, nearly 6 years to clear an $8,000 balance. And along the way, he pays around $6,200 in interest. So he pays over $14,000 to get rid of an $8,000 debt. That is the part people miss. Jake is not irresponsible in the obvious way. He is not missing payments. He is not ignoring bills. He is not doing something dramatic. He is just standing on the wrong side of the interest rate line. Now compare that to Brian. Brian has debt too. He has a 30-year fixed mortgage at 6.5%. If you use the good debt, bad debt labels, people would say, okay, that is fine. Mortgage equals good debt. But the mortgage is not really the most important part. The important part is Brian does not carry anything more expensive than that mortgage. No revolving credit card balance. No financed furniture, no stack of buy, now pay later. No consumer debt sitting at 20% or 30%. So when Brian has extra money each month, it does not go into a credit card hole. It goes to work. Say Brian invests $500 a month. That is the same kind of money Jake is feeding to his card. A 10% return, which is the long-run nominal number people often quote for the stock market. $500 a month grows to about $102,000 in 10 years. About $380,000 in 20 years, and just over $1.1 million in 30 years. Now to be honest, that last number is nominal, before inflation. In today's dollars, the source says it lands closer to about $610,000, still from $500 a month. That is what happens when the money is on the right side of the line. So what divides Jake and Brian? It is not that one has debt and the other does not. Both have debt. It is not even discipline. Jake is disciplined. He pays every bill on time. The difference is the rate their money is attached to. Jake is stuck at 21.5% working against him. Brian has cheaper fixed debt and money working for him at maybe 10% over the long run. Same basic tool, different direction. So where is the line? The line is where your debt's interest rate crosses the return you could earn with that money somewhere else. Below the line, the debt is cheaper than your expected return. So keeping it and investing the difference can make sense. Above the line, the debt costs more than your money can reliably earn. So paying it off is usually the better move. Now we need a practical number. The safe return right now from high-yield savings or treasury bills is around 4% in the source. That is not exciting, but it is relatively safe. The ambitious long-term stock market number is around 10%. But that is not guaranteed, it is not smooth, and it can disappoint in the short term. So practically, above roughly 8%, a debt probably costs more than you can reliably beat elsewhere. That is usually debt to attack. Below roughly 6%, especially if the rate is fixed, you may be better off keeping the debt and investing the difference. And between 6% and 8%, you are in the gray zone. That is where taxes, risk tolerance, cash flow, how stable the rate is, and how much peace of mind matters all start to matter. There is one detail that makes high-interest debt even more urgent. Paying off debt is not just a return. It is a guaranteed, tax-free return. If you earn 10% in an investment account, you may owe taxes on the gains. But if you pay off a 20% debt, you are not creating taxable income. You are removing an expense. So when Jake pays off his 21.5% credit card, he is not just avoiding a bill. He is getting something like a guaranteed tax-free 21.5% return by no longer paying that interest. There is almost no legal normal investment that can reliably give him 21.5% tax-free with no market risk. The stock market might average around 10% over the long run, and it is risky and can be taxed. A great savings account might pay around 4%, but the credit card payoff is sitting there disguised as a bill. That is why high-interest debt can be the highest return investment many people have access to. It just does not feel like an investment because the statement says payment due. This is where the good debt, bad debt labels fall apart. They would tell Jake, credit card bad, pay it down eventually. But they do not show him that paying it off may be the best financial move of his life. And this is also where the wealthy come into the story. You have probably heard that rich people use debt to get richer. They borrow instead of selling. They use assets as collateral, they somehow avoid taxes. There are exaggerated versions of this online, especially from people selling courses. But there is also a real version, and the real version is just the same line with more zeros. The strategy is often called buy, borrow, die. The idea is simple. Wealthy people buy assets that can appreciate. Stocks, real estate, companies, whatever the asset is. They hold the asset, so they do not sell and trigger taxes. And when they need cash, they may borrow against the asset instead of selling it. If they can borrow at a low rate while the asset keeps growing at a higher rate, they are borrowing cheap and earning more. That is the left side of the line. Now, I am not saying this is where most people should start. Borrowing against investments adds real risk. If the market drops hard, the lender can demand more collateral, or the loan can be called, and you can be forced to sell at the worst time. So this is advanced, but it proves the concept. The wealthy are not using a completely different tool. They are using debt only when the rate and the asset return make the math work. Here is a normal person version of that mechanism. Imagine you need $50,000 and you already have it sitting in investments. The obvious move is to sell. But selling may trigger tax if $30,000 of what you sell is gains. And those gains are taxed at 15%. You hand the government $4,500. And you also lose the future growth on what you sold. The alternative is borrowing $50,000 against the portfolio at around 7%. While leaving the investments alone to compound at maybe 10%. You pay 7%, you earn 10%. You keep the 3-point spread, about $1,500 in the first year. And you defer the tax bill. Again, not free, not riskless. But it is the same comparison, rate on debt versus return on the asset. That is why debt and wealth are not really opposites. Debt is a lever. If the lever points below the line, borrow cheap and earn more. It can build wealth. If it points above the line, borrow expensive and earn nothing. It drains wealth. So what do you actually do with this? Pull up every debt you have. Credit cards, car loans, student loans, mortgage, personal loans, buoy now pay later. Whatever it is. Write down the balance, write down the interest rate, then rank them by rate. Highest first, a credit card at 21.5% is far above the line. That is probably the highest return payoff available to you. Attack it first. A payday loan or buy now, pay later balance creeping toward 30% is an emergency. Treat it like one. A personal loan around 12% is still above the line. That is next in the queue. A car loan around 9% is also above the line. Even if the gap is smaller. A student loan around 6.5% is more of a gray zone. Maybe you keep paying it on schedule and invest alongside it. A fixed mortgage at 6.5% is also a gray zone. Paying it down gives you a guaranteed 6.5%. Investing the difference might earn more, maybe around 10% over time, but it is not guaranteed. So this is not obvious in either direction. Onion who tells you it is always obvious probably has not actually run the numbers. This process replaces good debt and bad debt with a ranked list. Highest rate first. Attack from the top. Once you get below the line, you slow down the debt attack and start investing more. There is one major exception. If your employer offers a retirement match, capture that match first if you can. Because a 50% match is a 50% instant return. That beats even the credit card math. After that, the line decides, and the same logic applies on the asset side. If you keep $50,000 in a typical big bank savings account, paying around 0.38%, you earn about $190 a year. The same $50,000 in a high-yield account at 4% earns around $2,000, more than 10 times as much, with basically the same insured safety. Same money, similar risk, different rate. And the only difference is whether you checked. This stuff adds up over a lifetime. In the source, Brian and Jake earn the same paycheck. Brian invests his surplus from the beginning. Jake spends nearly 6 years clearing a credit card before he can really start. That head start, just being on the right side of the line sooner, is worth about $174,000 over 30 years. Not because Brian earned more, not because he had some secret investment, but because the same lever was pointed the right way earlier. So the practical takeaway is this. Debt is not automatically good or automatically bad. Debt is a rate measured against an alternative. That comparison is something you can run on every loan you have in a few minutes. You do not need to be rich to do that. You do not need a complicated model. You need the rate. You need the balance. And you need a realistic idea of what your money could earn elsewhere. If the debt is expensive, paying it off may be your best investment. If the debt is cheap and fixed, investing the difference may be the better move. And if it is in the middle, you make a judgment call based on risk taxes, cash flow, and how much peace of mind matters to you. That is how you stop guessing. Because if you do not understand debt, you probably do not understand wealth yet. Not because debt is complicated, but because wealth is often built by knowing which rates to destroy, which rates to keep, and which rates to earn. So pull up the statements, find the numbers, rank the debts, and make the next move from the math, not from the label.